Okay, so let's keep going with these concepts, these matching concepts, and it says here that what we're going to do is we're going to match each situation related to some type of inventory error or potential inventory error, and we're going to match that situation to its impact on current year's net income. So basically we've got three things. We have the fact that net income will be overstated for the year based on what we do down here, or that it will be understated. And then the third possibility is that there's no impact on net income, okay? Because not all of these things down here are actual mistakes. So let's start right here with the first one. It says we purchased merchandise, or purchased merchandise was shipped FOB shipping point on the last day of the year. The cost of the merchandise was not included in ending inventory. Okay, so the fact that it says purchase, we're talking about the buyer here. Well, if you recall our discussion about FOB shipping point and destination, because it was shipped, and it was shipped FOB shipping point, at the moment that it ships, whether it has arrived at our company headquarters or not, and if it's done on the last day of the year, it's probably not going to arrive, we have to include that in ending inventory. So let's think about this. If we were supposed to include it in ending inventory and we did not, what happens? Is our inventory, I want to take this in pieces, is our inventory, is it understated or is it overstated? Well, I'm sorry, I made a mistake there. Our inventory is understated. Okay, our inventory is understated because we were supposed to include this merchandise in ending inventory and we did not. Okay, so when we reconcile our inventory, we're going to essentially, we're going to say, okay, these are the sales that we've made over the course of the year, and ultimately we're going to take the inventory that's not there from all of the goods available for purchase, and we're going to figure out cost of goods sold based on that information. So if inventory is understated, that makes it look like we went through more inventory to get to our sales. So what that means is that cost of goods sold is actually going to be overstated. Okay, cost of goods sold in this case is overstated because what happens is if we have an issue with our inventory, and this would be true even if we were not dealing with a shipment that took place on the last day of the year. Let's say that our inventory was supposed to be 168,000. But due to shrinkage and breakage and so forth, when we counted it, it was really we only came up with 166,000. Well, that $2,000 difference would immediately go into cost of goods sold. And it's going to lower our net income. Okay? Here we have a situation where we're counting the inventory, let's say as 166,000, but we've got this merchandise that should have been included, and we'll just pretend that this merchandise is worth $2,000. So we're expensing $2,000 too much, okay? And if we're expensing $2,000 too much, that means that our net income is going to be understated because our expenses are too high, all right? So the answer here is going to be B. That was a bit of a long-winded explanation, but I want you to get this if at all possible. All right, next one says merchandise was purchased FOB destination on the last day of the year. The cost of merchandise purchased was not included in ending inventory. All right. So it's essentially the exact same thing as this situation here, except that instead of FOB shipping point, we have FOB destination. So we're not supposed to count it until we get it, and we didn't count it. Therefore, we have no error, and we have no impact on net income. So our answer is going to be C. All right. Merchandise held on consignment was included in the count of ending inventory. All right, so we need to, let's do a real quick review of what this means here. Merchandise that we do not own. We don't own this. It has been consigned to us, and we're acting as an agent to sell it for somebody else, and we're only going to pay them whenever that merchandise actually sells. So it's not ours. So if we count it in our ending inventory, all right, then inventory is overstated. That means that cost of goods sold is understated. Okay? And then net income is going to be overstated. I will tell you one thing. If you can figure out what the impact is to cost of goods sold, you can always go the opposite way and figure out what the impact is to net income. All right, so let's think about this. Let's use our previous example, our numbers. Let's say that we had $2,000 of merchandise that was held on consignment. Our inventory, when we counted that, was $168,000, using the same numbers we used before. Well, in reality, it's $166,000, right? So that $2,000 makes it look, that we counted by mistake, makes it look like we went through $2,000 less inventory than we actually did to generate those sales. Okay, so we're going to understate our expense item cost of goods sold, and anytime you understate an expense, net income is going to be overstated. So with that said, let's go ahead and get the answer down. It is. All right. A consignor included merchandise in the hands of the consignee in ending inventory. Okay? So the consignor is the owner of the merchandise, but it's not in his physical possession. It's at some store waiting to be sold, and he included it in his ending inventory. Well, that's exactly what he was supposed to do. So there, in fact, there is no impact on net income. Beginning inventory was overstated. I'm sorry, beginning inventory was understated. Okay, so let's think about this now. And we're just going to do a little bit of an example here. Let's say that we had inventory of $20,000, $20,000 as our beginning inventory. Okay, that's what we thought we had. All right, and then throughout the year we bought $150,000 in additional inventory, and we get to the end of the year and we decide, we figure out that we have $30,000 in ending inventory. Okay, so this is our cost of goods sold formula. We have $20,000 beginning inventory plus $150 purchases is $170, right? $150 plus 20 is $170, minus the $30,000 in ending inventory that we still have. We can't expense that because we still have it. Would equal $140,000 cost of goods sold. But let's say that we were supposed to have had $25,000 as our beginning inventory, and that everything else was the exact same. Okay? Now, let's see what happens. Well, 25 plus 150 is 175, minus $30,000 ending inventory. So our true cost of goods sold, $145K for cost of goods sold, right? So if beginning inventory is understated like it is here, our cost of goods sold is going to be understated, and net income is going to be overstated. Okay, so net income overstated, that is letter A. Merchandise that was sold and shipped FOB destination on the last day of the year was not included in the seller's inventory. Okay, so now we're talking about the seller, and we're saying that it was not that he sold at FOB destination. He did not include in his inventory, and this is actually a big problem. That's why most sellers prefer to ship stuff shipping point, so they can be done with their responsibility. Well, he was supposed to go ahead, I say he, the seller was supposed to go ahead and include this, but they didn't. Okay? So, what does that mean? What happened to inventory? Inventory is going to be understated. If inventory is understated, the seller's cost of goods sold is going to be overstated, and net income is going to be understated. So understated is choice B. Same thing with one small difference. Merchandise that was sold and shipped FOB shipping point on the last day of the year was not included in the seller's ending inventory, and it should not have been. He did this exactly right, because as soon as he shipped it, he no longer owned it. Therefore, he should not have included it in ending inventory, and he did not. Okay? The beginning inventory was recorded as $10,000 when actual inventory on hand was $12,000. Well, if we think about this, we have this exact same question right here. It's just they didn't give us any figures. But I'm not going to do this because I did an example right up here, but you could plug this in the same way that we did here, just substituting the 20K for the 10K and the 12K for the 25K here. And what you're going to find is, in this situation, that cost of goods sold is going to be understated. So when that happens, what's going to happen to net income? Well, it's the same answer as it is right up here. It's going to be overstated. Okay? That's the last one for this handout.